Right now, a silent heist is draining Western silver vaults. While New York traders sleep, the Shanghai Gold Exchange is pricing silver at a staggering $97 an ounce, nearly 10% higher than the West. Wall Street algorithms and institutional hedge funds have detected this massive anomaly. They are quietly buying physical silver in London, packing it into armored crates, and flying it straight to Asia to pocket millions in instant risk-free arbitrage. But here is the terrifying catch. What happens to Western savers when our physical vaults completely run dry? Behind the mainstream financial headlines, a massive geopolitical decoupling is taking place. The global silver market is fracturing into two entirely different realities. The West is staring at paper promises and digital derivatives. The East is aggressively physicalizing the market. This is the story of the Eastern Premium Arbitrage. It is a hidden mechanical drain that is breaking the Western financial pricing monopoly forever. Let us decode exactly how this smart money is playing this game. To understand how this drain works, you have to look past the digital ticker on your phone. Most retail investors look at the spot price and assume the market is uniform. They think a silver price in New York is the exact same as a silver price in Tokyo or Shanghai, but it is not, far from it. Right now, a structural dislocation has opened up between the Western paper exchanges and the Eastern physical hubs. This has triggered a textbook four-step arbitrage loop. It is a highly sophisticated, multi-million-dollar logistics operation executed by institutional hedge funds and market makers. Step 1 is simple. The funds buy physical silver contracts at artificially depressed prices on Western exchanges like the New York COMEX or the London Bullion Association. Then comes step 2. Instead of settling the contract in cash or rolling it over to the next month like most paper traders do, these funds do something different. They demand physical delivery. They want the actual heavy bars of silver. They want them out of the Western vaults immediately. Step 3 is the physical migration. The hedge funds pay for heavy-duty armored transport, high-security air freight, and massive insurance policies. They pack the silver into crates and fly it across the world straight to mainland China. Finally, step 4. The moment the planes land, the silver is transferred to the Shanghai Gold Exchange. The funds sell it instantly at the Eastern premium price. They pocket a risk-free profit of nearly $8 to $10 on every single ounce. Think about that math for a moment. On a standard 1,000-ounce commercial bar, that is a pure $10,000 arbitrage profit. Now multiply that by tens of thousands of bars. It's an absolute money-printing machine for institutional players. But that is not the real story. The real story is what this trade is doing to the plumbing of the Western financial system. And this is where things get dangerous. This arbitrage loop is not just a statistical anomaly. It is a massive structural vacuum cleaner. It is sucking real physical metal out of London and New York at an unprecedented pace. Let us look at the hard data. This is not speculation. This is coming straight from the COMEX warehouse regulatory reports. Since its peak in 2020, the registered inventory of silver, the actual physical stock available for delivery on the COMEX, has plummeted by more than 70%. Nearly 3/4 of the available silver has vanished from Western institutional custody in just a few short years. Let that sink in. 70%. Gone. Because behind the headlines, Western regulators and bullion banks have been suppressing prices using paper derivatives. For decades, they sold synthetic silver that didn't exist to keep the price low. They created a massive illusion of abundance. But you cannot fly a paper contract to Shanghai and sell it for a premium. The East only settles in real physical bullion. Shanghai demands the metal. And this is creating a massive crisis for the average investor in the US and Europe. While Western retail savers are conditioned to buy digital ETFs, paper silver certificates, and unallocated bank accounts, the physical backing under those accounts is eroding. Western savers are left holding nothing but electronic promises on a screen. They think they own safe haven assets. They think they are protected against inflation. But the actual tangible silver that supports their wealth is being loaded onto cargo planes.
It is being bolted into Asian vaults, never to return. The West is keeping the paper liability. The East is taking the physical asset. It is a slow-motion run on the Western bullion banking system, a physical drain masked by a paper price tag. And the window to exchange your fiat currency for real physical protection is closing faster than Wall Street wants you to believe. When mainstream Western analysts look at this surging premium in Shanghai, they quickly dismiss it. They call it a bubble. They claim it is just a wave of blind retail speculation by Chinese savers looking for a quick trade. But they are completely misreading the market. This is not a temporary speculative frenzy. It is something far more profound. This is a fundamental, structural repricing of physical reality. Think about it. Why would a massive industrial powerhouse like China willingly pay a 10% premium for silver over the Western spot price? Is it just madness? No, it is math. The Western pricing mechanism is broken because it treats silver like a dying financial asset. But the East understands the ground reality. Silver is no longer just money. It is the literal infrastructure of the future. We are standing at the intersection of a green energy mandate and an artificial intelligence revolution, and both of these structural megatrends are completely starved for physical silver. Look at the hard industry data. According to official customs reports, China's silver imports recently hit a staggering record of 836 tons in a single month. Why? Because China manufactures over 80% of the world's solar panels, and every single photovoltaic cell requires physical silver paste to conduct electricity. At the same time, the domestic build-out of data centers and advanced semiconductor chips for AI infrastructure is exploding. You can simulate a stock market crash on a computer. You can print an infinite amount of digital currency, but you cannot build a high-performance AI chip, an electric vehicle, or a solar grid without physical atoms of silver. There is no synthetic substitute, and the global supply is simply not there. Data from the Silver Institute exposes the cold, hard truth. The global silver market is currently locked in its 6th consecutive year of massive structural deficit. And this year alone, the shortfall is projected to reach an unprecedented 215 million ounces. The West is pretending that supply and demand can be balanced by trading digital paper contracts on Wall Street. But the factories in Shanghai cannot build solar panels out of paper. They need the metal. And this is where the real macro risk comes into play. China and the broader BRICS nations are completely aware that the Western financial system is drowning in sovereign debt. They see the US debt clock ticking higher by trillions of dollars every single year. The fiat dollar is being structurally debased by unchecked inflation. So they are executing a strategic pivot. They are actively repricing hard assets. By allowing the physical price of silver to rip higher on the Shanghai Gold Exchange, the East is sending a clear message to the world. They are declaring that a real physical commodity is worth far more than the artificial price dictated by paper derivatives. For decades, institutional bullion banks in New York and London used short positions and synthetic contracts to suppress the price of precious metals. It allowed Western central banks to maintain the illusion of dollar stability. If gold and silver stay low, the fiat currency looks strong. But Shanghai is breaking that illusion. They are not manipulating the price up. They are simply allowing the natural law of extreme scarcity to assert itself. The Eastern premium reflects the true market value of an asset that is running out. The Western spot price reflects an artificial value created by paper dilution. This is a quiet monetary rebellion. The East is cornering the physical market by simply paying what the metal is actually worth. And this leaves Western investors exposed to a brutal realization. While you are watching a manipulated ticker on a Western exchange, the true physical floor is being pulled out from under you. The true value of your wealth is being decided in the East, and they are pricing you out of the market. Whenever a commodity experiences an historic supply deficit, classical economic theory dictates a simple solution. Higher prices will incentivize miners to dig faster. They will open new facilities, they will flood the market with fresh supply, and the price will normalize. But that's not the real story. In the silver market, that textbook solution is a physical impossibility. The market is walking straight into what geologists call the byproduct trap. Let us look at the hard data from mining.com. Most investors assume that when they buy shares in a silver mining company, they are investing in a company that purely hunts for silver.
But behind the headlines, the reality of global geology is completely different. Only about 30% of the world's silver comes from primary silver mines. The remaining 70% is extracted entirely as a secondary byproduct. It is an accidental yield found while mining for industrial base metals, specifically copper, lead, and zinc. And this is where things get dangerous. Because silver production is physically tied to base metals, a primary silver mining boom cannot save the West. If a global economic slowdown reduces the demand for industrial housing, infrastructure, and commercial manufacturing, the demand for zinc, lead, and copper plummets. When big industrial miners slow down their copper and zinc operations, global silver production drops right along with it. It does not matter if the price of silver hits $90, $100, or even $200 an ounce. A mining company cannot economically justify operating a massive, multi-billion-dollar copper mine just to extract the tiny veins of byproduct silver inside it. The physical supply of silver is locked in a geological cage. The supply cannot scale to meet the exploding demands of the AI revolution and the solar grid. The emergency exit for the Western banking system has been welded shut by the laws of nature. Yet, if the physical shortage is this severe, why is the average investor in New York, London, or Frankfurt completely oblivious? The answer lies in behavioral finance. It is a psychological phenomenon known as risk numbness. For the past decade, Western retail investors have been deeply conditioned by an historical pattern. They have watched a historic bull market in giant tech stocks. They look at the S&P 500 or the NASDAQ breaking records every quarter, and their brains translate that green screen into a false sense of absolute systemic safety. They have developed a profound decision fatigue when it comes to risk. They see systemic warning signs, sovereign debt hitting unprecedented levels, banking instabilities, sticky inflation, and they feel absolutely nothing. Their financial amygdala has been completely fried by constant warnings that never seem to affect their stock portfolios. They suffer from an illusion of knowledge. They believe that if a true systemic liquidity crisis were approaching, the institutional markets would price it in. They trust the system blindly. But history proves that the masses never smell the smoke until the theater is already on fire. While the average Western investor is hyper-focused on corporate earnings reports and tech stock splits, they are completely missing the physical liquidation happening right beneath their feet. They are ignoring the empty vaults at the COMEX. They are ignoring the massive, risk-free arbitrage flying out of London every single day. They are holding on to digital promises, convinced that liquidity will always be there at the click of a button. They do not realize that paper wealth can vanish in a weekend when the physical collateral backing it is gone. The smart money in the East is exploiting this exact complacency. They are quietly buying the real world while the West trades digital shadows. And by the time the average investor wakes up to reality, the physical vaults will be entirely empty. The widening Eastern premium is not a market glitch. It is not a temporary statistical deviation that Wall Street algorithms will smooth out next week. It is an early seismic warning. What we are witnessing is an historic, irreversible shift in global monetary gravity. For over a century, London and New York held an absolute pricing monopoly over hard assets. They controlled the world's wealth through digital screens and paper leverage. But that era is drawing to a close. The pricing power over real, tangible reality is migrating from west to east. It is moving from the entities that print endless paper promises to the nations that build physical infrastructure and hoard physical bullion. And this is where things get dangerous. The institutional hedge funds playing this arbitrage game are running out of runway because this game has a hard mathematical ceiling. It relies entirely on the existence of physical metal left inside Western vaults. So, ask yourself the ultimate macro question. What happens when this arbitrage loop finally ends? What happens when the vaults at the COMEX and the LBMA hit absolute zero? When there are no more physical ounces left to withdraw, the Western paper pricing mechanism will experience a catastrophic reset. The illusion of abundance will break overnight. The synthetic paper contracts will default, and the physical price of silver will disconnect into a reality that no fiat currency can contain. Hedge funds are flying physical metal out of your country every single day. Are you going to keep holding your wealth in paper bank statements, or is it time to look at what the smart money is actually doing? Let me know your thoughts in the comments below. How long do you think COMEX has before the vault hits zero? Don't forget to subscribe for the next macro deep dive.